On today's hot sheet, I'm discussing job openings and labor turnover for December 2024, the ADP employment report for January, and mortgage application data for the past week. Today is Wednesday, February 5th. It's BAM Pro Bowl day here in 2025. I am Byron Lazine, and your hot sheet starts now. Welcome into the hot sheet here on this Wednesday, February 5th, BAM Pro Bowl day, the second ever Pro Bowl. Just imagine if you were at the second ever Super Bowl back when the Green Bay Packers won back-to-back Super Bowls. And then from that point on, the trophy was named the Lombardi Trophy. Just imagine if you had the stories of being at the second Super Bowl ever. That's the opportunity you have here today by joining the second ever BAM Pro Bowl. Yes, in 10, 15, 20 years down the road, they'll be talking about these first ever Pro Bowls as historic moments. The BAM Pro Bowl is the Super Bowl real estate knowledge, the Super Bowl of real estate knowledge. And we're kicking off at noon Eastern, bamprobowl.com, to make sure that you can get your free access to this virtual event. We have so much entertainment stocked up for the Pro Bowl, bamprobowl.com. Link down below if you don't have your seat reserved. Do it now. We're kicking off live noon Eastern, 9 a.m. on the West Coast. This will be action-packed today. I've already seen a preview of Sharon's slides. They are epic. You're going to want to catch that. You're going to want to catch the conversation that I have with Jared James. Him and I were on the phone yesterday, just going back and forth on what that presentation is going to look like. Ken Pozak on YouTube, Tina Call on the 6 types of working genius you need to know this year, and Kofi Narte talking about how to level up that price point, that celebrity agent and celebrity working with celebrity. So a luxury component there. A lot other exciting stuff inside of Pro Bowl that I can't announce yet, but that's going to be at noon Eastern. And so this will be a quick one here today. We do have a bunch that we want to get through, but it'll be a quick hot sheet. We're all getting ready and geared up for noon Eastern. BAMProBowl.com. Replay for the Pro Bowl is available for BAM X members. So the only way to get this year's Pro Bowl replay of the first virtual event of the year is inside of BAMX, which obviously our BAMX members already know the announcement that's coming at Pro Bowl, the new platform for BAMX. Unbelievable. We're going to be announcing that publicly at the Pro Bowl, but the new platform's outstanding. Everybody's just super jazzed about that, and it'll be inside of there for BAMX members. There will be no replay. The instant replay game is silly, right? For BAMX members, they should have access to it. They're busy, but this is a live event. We want you to be there live if you're signing up and not a BAMX member. Totally free event. Obviously, get it if it was a paid event and all that there'd be a replay going out. But BAMX members, you get it. So become a BAMX member if you want access to that. That'd be great. All right, let's get into the job openings and this is something we're watching closely right now. Job openings. This is a big jobs week. There's going to be a full jobs report on Friday, but we're getting little bits and pieces here during the week. We want to pay attention to this as it relates to the 10 years. Is this pushing the 10-year down? Is it going up? Right? One of the things that the FOMC has been clear about is, don't expect long-term rates to really move unless the labor market breaks. Logan Motoshami over at HW is not the only one saying it. Jerome Powell said it last week quite clearly. If we were listening, and I know everybody here on the hot sheet was, that's one of the things that's super clear right now. Like, we're not going to get a 30-year fixed mortgage to start moving down. And I'm not even talking fast or rapidly. I'm just talking about at all without some labor breakage. 2% inflation is a pipe dream. We're not going to get there in 2025. It's an arbitrary number to begin with. And there's a lot of reasons why that number is going to stay inflated. I don't expect 2% inflation in 25. Neither do the analysts. There's nobody calling for it, not Jerome Powell himself. And so you've either got to rely on labor, or what I would fear the most and don't want to see happen is some type of black swan event, some type of crisis that forces rates to be pushed down, and nobody's rooting for that. So really, we need a labor market to ease up as the only realistic, non-damaging chance to the greater economy for the long-term rate, the 30-year fix, to move down. So let's dive into it. Here are the latest numbers on job openings. We've got 7,600,000 as the latest job opening level. This is as of December. Okay, cool. Latest hire rate is 3.4% in December. Latest total separations rate, 3.3%. Let's focus on the top line number. That's what the market's going to react to, the 7.6 million. That 7.6 million, which is down 556,000 from November. Okay, down 556,000 in November. That's job openings. It's how many jobs are available. The more openings that are on the market, basically, hey, the more homes that are on the market, the more power buyers have. The more job openings available on Indeed and other job platforms, the more leverage the employee has on the employer to negotiate better terms, bonus, whatever the case may be. Hey, there's all these openings, there's all these opportunities. Everybody wants me. I'm super qualified for a lot of positions. The leverage goes to the employee in that case, or the job applicant. Those numbers are reducing. If we look now back a year, 556,000 down from November, but down 1.3 million year over year. This is a 4.5% decrease over the month, and it's 1.3 million year over year. Out of that 7.6 million, the other thing you got to ask yourself is how many of these jobs are good jobs? How many of these jobs are everybody qualified for? How many of these jobs are super technical or jobs that nobody wants? But, there's a lot of that in both. Some of the biggest decreases right now have been in professional and business services, down 225,000. Healthcare and social assistance, down 180,000. Finance and insurance, down 136,000. Arts, entertainment, and recreation increased 65,000. So professional, business services, finance, insurance, these are jobs that typically will go above median wage earner. Those are down. Reason why some of these things might be good for long-term rates is it shows that there's a continuation in the job market cooling. This isn't an overheating job market. This is a job market that is stabilizing. This is a job market that doesn't have a ton of options that's going to push wage growth, through the roof. That's not great news for home buyers trying to battle affordability. There's only, 3 ways they can afford a house. It's like a rapid increase in wages. These numbers suggest that that's probably less likely. Number 2 would be home prices come down dramatically. We talked about all the equity yesterday. If you're a homeowner and you're going to go to sell, what's the motivation to just give a discount right now? Doesn't make any sense. Or number 3, the rates to come down. So we know this is going to, not help the affordability issue that we have, but it can in the way that you connect it to the 30-year fixed. Okay, Steve is razzing me there. Likey or likely. What do you like better, likey or likely? Let me know. All right, so there you go on the job openings, and we'll see. Okay, we'll see what happens here as we move forward. The Fed's paying attention. One thing that I noted right off the bat this morning, that I do likey, Steve. I do likey this quite a bit. I likey it a lot. This is the U.S. 10-year. This is 4.45. Just yesterday, we were up over 4.5. Okay, so we're down here 4.452. This is off some of these job reports. This is good news as we fast forward here between now and the next meeting. This is the low point for the last 30 days. RM, me likey too. I likey this, the 10-year. I like it moving down. I'd love it if it impacts the 30-year fixed, which, wow, I haven't seen this kind of stability since we just haven't seen it since COVID. I mean, these are pre-COVID levels of consistency. Talk to your lender. When's the last time you saw just 6, 7, 8, 9, 10 readings that were all identical. This is what you would see in, just most normal years before COVID. And since obviously COVID, we just kept going down, down, down. And then middle of 22, they ratcheted up. This is historically just in a normal year, what you see on the 30-year fix, just it not moving. In the last 3 reads, we haven't moved at all. 7.05. Love for this lower 10-year here today to push it down into that high 6s. We're going to talk about mortgage applications and what's going on here in just a bit. Some of the news now starting to stack up on mortgage applications is presenting at least a cautionary flag for me, something to think about in the spring. But for the mental barrier, if this 30-year fix can drop under 7, even in the high 6s, that'll help. That'll at least help hopefully turn the corner on that. All right, just to clean up jobs before we get to mortgage applications, let's go to the ADP research. Again, the big jobs numbers coming on Friday. We'll clean that up on Monday here on the hot sheet. We'll be paying attention, seeing if that can maybe, hopefully start getting that 30-year fixed into the 6s, which we'd all like to see just in time for spring. That'd be amazing. The national employment report for ADP, private sector employment increased by 183,000 jobs in January. They're saying annual pay is up 4.7. So private sector employment moving up in January and the annual pay up 4.7 year over year. This job report and pay insights here from ADP has us in, let's look at each sector here. Higher momentum in the last quarter of 2024 carried in January with some exceptions, including manufacturing. You've got change by industry sector. Manufacturing down 13,000. Service providing is up. That includes trade and professional business. So this is actually hiring. We were just looking at the obviously openings versus what's actually happening on the hiring now. Change in the regions. So New England up 5,000, Middle Atlantic up 17,000. So Northeast adding 22,000, the Midwest adding 64,000 on a top line. The South adding 50,000. The West, South, Central lost 19,000. So the South Atlantic, East, South, Central were the drivers for the South. The West up 70,000. That's 54,000 coming from the Pacific. We look at what type of businesses here are hiring. Small establishments at 39,000. That's 1 to 19 employees. That's 20 to 49. Medium-sized in establishments was the biggest hire. Okay, so that's 50 to 499 employees is that category, 92,000. And then in January, and then large establishments, 500 plus employees, publicly traded company, this kind of deal, 69,000. So the large employees not hiring as much as some of those medium growth establishments. Just something interesting there as we look at the health of the economy and what that might mean. How are the larger companies thinking about the future? Here's the chief economist from ADP, Neela Richardson. We had a strong start to 25, but it masked the dichotomy in the labor market. Consumer-facing industries drove hiring, while job growth was weaker in business services and production. We saw that with the business services on the job openings as well. Okay, here's the change since 2014 in private employment. Continues to move up nationally. Change in U.S. private employment from pre-2014, we were under 115 million. Now today, well over 130 million. The bottoming out in May of 2020 went to 117 million. That number has obviously fully recovered to pre-pandemic level of 126 million plus and beyond today to 131 million. Again, here are those changes by establishments. So there you go on that number with what actually was according to ADP, what was hired there for January. Again, we get the big jobs report on Friday. We'll keep paying attention to this. Right now, what we saw yesterday was the markets did approve of these numbers. We're not getting into an overheated market. That's the big takeaway. Okay. My girls hate it when I have this little tea kettle I love having a little tea at the end of the day, a little tea before I go to bed. Like I'm 90, okay? But I love tea, decaf. And I leave that tea kettle on the stove sometimes. And when it starts whistling, my girls go crazy. They're like, I hate that noise. Get that tea kettle. The job market's not doing that. It's not the tea that I'm leaving on the stove too long until I hear the noise to take it off. It's becoming a normalized market. It's reacting very very normal. And we've got a stock market, an investor market that approves of that. And that's why we saw that 10-year have some relief here today. What we're not getting relief on right now, though, unfortunately speaking, is our mortgage applications. This is a time now. We're into February. This is the hot moment for the year. This is when historically lenders are going to say, I'm going to get the most, loan applications now, mortgage applications now, end of January, February, maybe into March. Like that's, if you look at their 12-month cycle in a normal year, now's when you get the most. So we want to see these numbers going up. We're still somewhat early in the game. I'm not waving a red flag. I'm waving a yellow. I'm going with a yellow card here on where we're at on mortgage applications. So applications top line number might sound promising, 2.2% from the 1 week earlier. We don't care about that number though. Okay. The top line number, we don't care because it includes refinance, and the refinance index increased 12% and was 17% higher than the same week 1 year ago. Why did refinances go up? Because rates now have kind of settled at about 7. They're not 7.25. So you had some relief there on the 30-year, where it doesn't seem like relief, but for those that are maybe 8.5 or whatever the case may be, saw an opportunity to go ahead, lock in at 7, take advantage of that. And you saw refinances week over week and year over year just increase, and that impacted that top line number. But when we look at this, what we care about here to drive sales in a spring market, now we've got a 2-2 tie. Okay. The seasonally adjusted purchase index decreased 4% from the week earlier. It was 0.2% higher than the same week a year ago. So that's a little bit of a silver lining, that we haven't lost pace basically the same week in comparison to last year, but we dropped down 4% from 1 week earlier when the rate, really just stabilized at just over 7. The rate didn't shoot up where you would expect a week over week drop. It showed us that the rate is having some pressure on buyers right now, taking that step to go and use their mortgage application. When I say we're at a 2-2 tie, we've got 2 readings here that were positive, and we've got 2 now that were negative to start the year. So we'd like this time of year, as we're entering in the spring market, to see more positive readings. We'll continue to watch this. Obviously, we'll be looking for more positivity on mortgage applications as we get into that spring market. It's one of the indications that we're going to drive pending sales and at least meet last year's spring, when we saw existing home sales at the lowest level in 30 years, or hopefully, we're hoping for it, surpass pendings here as we get into the spring. This was from Joel Kahn, MBA, Mortgage Banker Association Vice President, Deputy Chief Economist. Mortgage applications responded to the lower rates, talking about the refinances. So he's even saying that 7% stabilization was a lower rate than the week prior. Purchase activity had a tougher week. Declines across all types of loans. The average loan size for a purchase loan has increased since the start of the year and continued that trend last week, with the weaker government purchase activity, which reached 447,300, the highest level since October 2024. And so that's a tough week. It's a cautionary sign. Doesn't tell what the whole spring is going to be like. We're still sitting on mortgage applications. By the way, chart available inside of BAMX if you need it. We're still sitting at the lowest level since 94, 95 timeframe on this mortgage application. And we would just love to see this early spring pop to tell us more if the demand is going to meet that increase in inventory that we're all planning and hoping for. All right, there you go. There's your hot sheet today. Make sure you head over to bamprobowl.com. If you haven't reserved your seat yet, do it now. That thing will close out at 5,000. Last year, we almost hit 5,000. A lot of late signups happen in the couple hours before these virtual events. This is BAM Pro Bowl 2, the first of 4 virtual events from BAM this year. If you've been to a virtual event, you know the entertainment that gets poured into these events. We did the run of show yesterday, and I'm just amazed what the team at BAM has put together. You're going to be amazed. And this one it's BAM Pro Bowl 2. So it's the next level up. We've only improved from what we've got last year, all fresh conversations and that information that you need to really set up 2025 here for success. BAMProBowl.com. Grab your free seat right now before you miss out. I will see you guys over there live, noon Eastern, 9 a.m. on the West Coast. I cannot wait to kick it off with all of you. Until then, toodaloo.